These 5 stocks will make millionaires. 2025 has been one of the most confusing and misleading years the stock market has ever seen. The year began with fear. Headlines warned of tariffs, economic slowdown, geopolitical conflict, and a possible recession. Investors panicked. Markets sold off sharply. Confidence vanished almost overnight. Then, just as quickly, the narrative flipped. Markets rebounded violently. Indexes surged more than 50% from their lows. New all-time highs were reached. Commentators celebrated. Social media filled with victory laps. Suddenly, everyone believed the danger had passed. But something critical went unnoticed. Not every company recovered. While the overall market moved higher, several high-quality businesses were left behind. Their stock prices did not reflect the strength of their operations. Their fundamentals improved, but their valuations did not. That gap between price and reality is where real opportunity lives. Most investors never see it because they focus only on what already went up. They chase momentum. They assume rising prices equal good businesses. They confuse popularity with value. But investing does not reward excitement. It rewards discipline. The most successful investors in history did not win by predicting headlines. They won by understanding businesses and buying them when others were distracted or afraid. This video is not about guessing which stock will explode next week. It is about understanding why certain companies are positioned for a powerful rebound heading into 2026, even though the market has largely ignored them. The goal here is not to tell you what to buy. The goal is to teach you how to think. Because once you understand the process, you no longer need tips, predictions, or hype. You gain an edge that most investors never develop. The most important idea you must understand before we go any further is this. You are not buying a stock. You are buying a business. A business that produces cash. A business that reinvests capital. A business that either compounds value or destroys it. Your return has very little to do with daily price movements and everything to do with how much cash that business generates over time and how much you paid for it. Everything else is noise. In 2025, the noise was overwhelming. Indexes rose, but that rise masked a deeper truth. Some excellent businesses did not participate in the rebound. Their share prices stalled even as revenue stabilized, margins improved, and long-term strategies took shape. Those are the businesses this series focuses on, not because they are guaranteed winners, but because they are misunderstood. History shows that when strong fundamentals and weak prices diverge for long enough, price eventually follows fundamentals. That adjustment is rarely sudden. It is often slow, uncomfortable, and boring. That is why most people miss it. The first company we need to talk about is Nike. Nike is one of the most powerful consumer brands on earth. That statement is so obvious that people stop thinking about what it actually means. Nike does not just sell shoes. Nike sells identity. Nike sells aspiration. Nike sells culture. Brands like this do not disappear quietly. They do not collapse overnight. They go through cycles. Nike stock struggled not because people stopped buying athletic wear, but because the company entered a period of operational transition. Inventory built up, costs increased, margins compressed, leadership changed, analysts became cautious, short-term earnings projections deteriorated. Wall Street hates uncertainty, especially when it cannot be neatly modeled quarter by quarter. Long-term investors love it. Nike's new leadership launched a multi-year reset focused on core sports innovation, inventory cleanup, restoring wholesale partnerships, strengthening direct-to-consumer channels, and reducing structural costs. This is not a cosmetic change. It is a fundamental business realignment. Short-term profitability took a hit. That was expected. What matters is whether the brand remains strong, whether customers stay loyal, and whether capital continues to be deployed intelligently. Nike still generates billions in free cash flow. It still earns high returns on invested capital. It still has global distribution and pricing power. Those characteristics define a moat. Temporary margin pressure does not destroy a moat. Poor decision-making does. And Nike has not lost its discipline. Analysts focus heavily on near-term risks, tariffs, competition, cost inflation, and earnings volatility dominate the discussion. These concerns are real, but they are also temporary. Long-term investors ask different questions. Will Nike still exist in 20 years? Will it still generate cash? Will it still dominate global sports culture? Will it still reinvest profitably? If the answer is yes, then the only remaining question is price. A great business can still be a terrible investment if you pay too much for it. That is why valuation matters more than narrative. Nike's valuation reset created a window, not a guarantee, but an opportunity. The second company is Amazon. Amazon is often misunderstood because people try to simplify it. Amazon is not just an online store. It is not just a cloud provider. It is not just an advertising platform. It is all of those things at once. For years, critics argued that Amazon did not make money. Technically, that was true, but it was also intentional. Amazon reinvested aggressively, prioritizing long-term dominance over short-term profitability. Now that investment cycle is paying off. Margins are expanding. Cash flow is accelerating. Advertising revenue has become a major profit engine. Cloud computing remains the backbone of modern digital infrastructure. One of the most misunderstood aspects of Amazon is its capital expenditures. Free cash flow appears volatile because the company spends enormous sums on data centers, logistics, robotics, and artificial intelligence. That spending is not waste. It is infrastructure. Infrastructure that competitors cannot easily replicate. When sellers want to reach customers, they go to Amazon. When businesses need cloud services, they turn to Amazon Web Services. When brands want high-intent advertising, Amazon is one of the most powerful platforms available. These are not trends. They are structural advantages. Amazon's moat is deeper today than it was a decade ago, even though the stock has not reflected that reality consistently. The third company is Starbucks. Starbucks sells coffee, but that description misses the point. Starbucks sells habit. Habitual consumption is one of the most powerful economic forces in existence. When customers return daily, pricing power becomes extraordinary. Starbucks is no longer a hyper-growth story in the United States, and that has caused many investors to lose interest. But slow growth combined with strong margins, global expansion, digital integration, and dividend consistency creates something far more valuable than excitement. It creates predictability. Starbucks generates exceptional returns on invested capital. That means each dollar reinvested produces significant value. Few consumer businesses achieve this consistently. The company is restructuring operations, especially internationally. Short-term performance has suffered. Long-term efficiency is improving. China expansion, loyalty programs, digital ordering, and pricing strategy form a slow but relentless compounding engine. This is not a flashy story. It is a durable one. What ties these companies together is not hype or speculation. They are established, profitable, globally dominant businesses whose stock prices have lagged behind their operational realities. They are not broken. They are mispriced. And mispricing is the only true source of opportunity in markets. In Part 2, we will go deeper into valuation logic, earnings normalization, and why price matters more than stories. We will begin connecting these companies into a broader rebound thesis and explain why patience, not brilliance, produces the best long-term results. Stocks will make millionaires. The reason people fail in investing has very little to do with intelligence. It has almost nothing to do with access to information. And it has nothing to do with luck. It has everything to do with behavior. Most investors believe they are rational. They believe they make decisions based on logic, research, and facts. But when real money is involved, emotion quietly takes control. Fear at the bottom, greed at the top, impatience in between. This cycle repeats endlessly. The market does not punish ignorance. It punishes impatience. And that is why valuation matters more than anything else. You can buy the greatest business on earth and still lose money if you overpay. At the same time, you can buy a temporarily struggling business and earn exceptional returns if the price is right. Price is not a detail. Price is the foundation. Most investors never learn how to separate a good company from a good investment. They assume the two are the same. They are not. A good company can be a terrible investment. A boring company can be an extraordinary investment. The difference is valuation. When markets surge, valuation discipline disappears. People justify high prices by telling themselves stories. They say things like, "This time is different. Growth will continue forever. Margins will expand endlessly," or "Innovation will solve everything." Those narratives always sound convincing at the top. They sound ridiculous at the bottom. The stocks we are analyzing in this series exist in an uncomfortable middle ground. They are not collapsing. They are not exploding. They are quietly building value while the market looks elsewhere. That is exactly where patient capital belongs. To understand why these stocks are positioned for a rebound, you must understand how valuation actually works. Valuation is not prediction. It is probability. You are not trying to guess the future perfectly. You are trying to assess whether the current price offers you favorable odds. Think of it this way. If you buy a business that grows modestly, maintains stable margins, and returns capital efficiently, you do not need heroic assumptions to earn a solid return. You simply need time. But if you buy a business priced for perfection, any disappointment destroys your returns. That is the asymmetry most investors ignore. The reason the market rebounds violently after sell-offs is not because businesses suddenly become great again. It is because prices fall faster than fundamentals. Fear compresses valuations. Patience expands returns. In 2025, we saw this play out again. The sell-off punished everything indiscriminately. High-quality companies were dragged down alongside weak ones. When the rebound came, money rushed back into index heavyweights and headline winners. But some companies did not catch up. That lag is not random. It usually happens because the market is still anchored to old narratives. Nike is still viewed through the lens of inventory issues and margin compression. Amazon is still judged by capital spending fears. Starbucks is still seen as slow and mature. Those narratives may describe the past, but investing is about the future. The question is not what happened last year. The question is what these businesses will look like 5 and 10 years from now. Now we need to talk about earnings normalization. One of the most common mistakes investors make is assuming current earnings represent a company's true earning power. That is rarely the case during periods of transition. Businesses go through cycles. They invest. They restructure. They absorb short-term pain to strengthen long-term positioning. During those periods, reported earnings often look worse than reality. Nike is a perfect example. Inventory cleanup, supply chain adjustments, and strategic realignment hurt margins temporarily. But those actions are not recurring expenses. They are corrective actions. When normalization occurs, margins recover. Amazon is another example. Capital expenditures depress free cash flow in the short term, but they also create assets that generate returns for decades. Data centers do not disappear. Logistics networks do not evaporate. Starbucks fits the same pattern. Operational restructuring and international adjustments impact near-term profitability, but they do not diminish brand strength or customer loyalty. In fact, they often enhance it. Investors who understand normalization see opportunity where others see risk. Investors who ignore it sell at the worst possible time. Now, let us address growth expectations. The market has an unhealthy obsession with high growth. Anything growing slowly is dismissed as dead money. That mindset destroys long-term returns. Growth is not binary. A company does not need to grow revenue at 20% per year to be a great investment. What matters is consistency, durability, and reinvestment efficiency. A business growing at 5% annually with high returns on capital can outperform a fast-growing business with poor economics. That is why companies like Starbucks remain powerful wealth builders even when growth slows. Starbucks does not need explosive growth to compound value. It needs stable demand, pricing power, and disciplined capital allocation. Nike does not need to reinvent sportswear. It needs to maintain brand relevance and operational excellence. Amazon does not need to dominate new industries every year. It needs to continue monetizing the infrastructure it already built. These are not heroic assumptions. They are reasonable ones. The market often misprices reasonable outcomes because they are boring. That boredom is your advantage. Now let us talk about time horizon. Most investors operate on a timeline that guarantees failure. They say they are long-term investors, but they check prices daily. They panic on quarterly earnings. They react emotionally to headlines. True long-term investing is uncomfortable. It requires watching prices move against you without immediate validation. It requires trusting analysis over emotion. It requires patience most people do not have. The reason institutions outperform individuals is not intelligence. It is time horizon. Institutions are forced to think in years. Individuals think in weeks. That difference compounds. The stocks in this series are not get-rich-quick trades. They are wealth-building machines when owned patiently at reasonable prices. The market may ignore them for months or even years. That does not matter. What matters is that the businesses continue to generate cash, reinvest intelligently, and maintain their competitive advantages. Eventually, the market notices. It always does. Another critical concept most investors never learn is margin of safety. You do not buy a stock because you believe it is fairly valued. You buy it because you believe it is undervalued relative to conservative assumptions. That margin protects you from being wrong. If growth disappoints slightly, you are still okay. If margins take longer to recover, you are still okay. If sentiment remains negative, you are still okay. Without a margin of safety, you are speculating. With one, you are investing. Nike, Amazon, and Starbucks all present varying degrees of margin depending on price. None are automatic buys. All require discipline. That is the difference between investing and gambling. In the next section, we will expand beyond these three companies and begin connecting the broader thesis behind all 5 stocks. We will explore why rebounds often happen when investors least expect them, how capital flows shift over time, and why 2026 could represent a powerful inflection point for disciplined investors. These 5 stocks will make millionaires. One of the hardest truths in investing is that the best opportunities rarely feel good when you buy them. If an investment feels obvious, comfortable, and widely praised, the price already reflects that comfort. The market has already agreed with you. At that point, your upside is limited and your risk is hidden. Real opportunity feels uncomfortable. It feels lonely. It feels slow. It feels boring. That discomfort is not a flaw in the process. It is the signal that you are early. Most investors never experience this phase because they abandon positions before the payoff arrives. They mistake inactivity for failure. They interpret silence as danger. But markets reward endurance, not excitement. This is why rebounds are almost always missed. Rebounds do not announce themselves. They begin quietly, long before headlines change. Fundamentals stabilize first. Cash flow improves. Margins recover slowly. Management executes behind the scenes. By the time the story becomes obvious, the price has already moved. The stocks discussed in this series are not waiting for miracles. They are waiting for recognition. Nike does not need to invent a new category. It needs to execute its strategy consistently. Amazon does not need a breakthrough. It needs to harvest the infrastructure it already built. Starbucks does not need explosive growth. It needs operational normalization and disciplined expansion. These are not risky assumptions. They are reasonable ones. And reasonable assumptions, when combined with favorable pricing, create powerful outcomes over time. One of the biggest misconceptions about investing is the idea that returns come from being right. They do not. Returns come from being right at the right price. You can be correct about a company's future and still lose money if you overpay. You can also be wrong in the short term and still win if you bought with enough margin of safety. This is why valuation matters more than conviction. Conviction without valuation is gambling. Valuation without conviction is paralysis. The balance between the two is where successful investing lives. Another mistake investors make is confusing volatility with risk. Volatility is movement. Risk is permanent loss of capital. The two are not the same. Nike stock moving up and down does not change the brand. Amazon's price swings do not weaken its logistics network. Starbucks trading sideways does not reduce customer loyalty. Price volatility only becomes risk if you are forced to sell at the wrong time. That usually happens when investors overextend themselves, rely on borrowed money, or invest with a timeline they cannot emotionally tolerate. Long-term investing requires emotional discipline more than analytical brilliance. The market is designed to test patience. It will make you question your thesis repeatedly. It will tempt you with faster-moving alternatives. It will punish you for acting too early and mock you for acting too late. That is not an accident. It is how capital transfers from the impatient to the patient. The reason institutions dominate long-term returns is not because they predict better. It is because they stay invested longer. They allow compounding to do its work. Compounding is not dramatic in the early years. It is subtle, almost invisible. Then, after enough time passes, it becomes overwhelming. Most people give up before that phase arrives. Nike rebuilding margins will not create headlines overnight. Amazon monetizing its ad platform will not trend on social media. Starbucks refining its international footprint will not excite speculators. But these processes accumulate. Each year of stable cash flow builds on the last. Each incremental improvement compounds on previous gains. Over time, the business becomes stronger, even if the stock price remains quiet. Then one day, sentiment shifts. Analysts update models. Institutions rebalance portfolios. Capital rotates. The same stock that was ignored becomes desirable. At that point, the easy money is already gone. The uncomfortable waiting period is where the real work happens. Another critical factor that supports the rebound thesis is capital flow behavior. Markets move in cycles. Capital flows toward growth, then toward value, then toward safety, then back toward growth again. These cycles are driven by psychology, not logic. In 2025, capital crowded into perceived winners. Index heavyweights absorbed enormous inflows. Meanwhile, companies in transition were left behind. That imbalance does not last forever. As growth expectations normalize and interest rates stabilize, investors begin searching for reliability instead of excitement. Cash flow, dividends, and pricing power regain importance. This is when companies like Nike, Amazon, and Starbucks re-enter focus. Not because they changed overnight, but because investor priorities did. Rebounds are often not about improvement, they are about revaluation. When expectations reset lower, businesses only need to perform reasonably well to surprise the market. That is the asymmetry working in your favor. Consider how expectations currently sit. Nike is expected to struggle near term. Amazon is expected to spend heavily. Starbucks is expected to grow slowly. If reality comes in even slightly better than those expectations, valuation expands. If expectations are already low, downside is limited. Upside becomes asymmetric. That is how long-term investors think. They do not ask what could go perfectly. They ask, what must go wrong for them to lose? This mindset transforms investing from speculation into probability management. It is also why patience is not optional. Patience is the strategy. Without it, even the best analysis fails. This is where many investors sabotage themselves. They buy with a long-term thesis, then abandon it the moment short-term noise appears. They sell not because the business changed, but because the price did not move fast enough. Time is not the enemy. Emotion is. If you want to build wealth through investing, you must align your behavior with your timeline. If your timeline is 10 years, daily price movements are irrelevant. Quarterly fluctuations are background noise. What matters is whether the business is stronger, weaker, or unchanged over time. Nike strengthening its brand pipeline matters. Amazon expanding its profit engines matters. Starbucks deepening customer loyalty matters. Everything else is distraction. As we move toward the final sections of this series, the goal is not to convince you that these specific stocks are guaranteed winners. There are no guarantees. The goal is to show you how to recognize opportunity when price and fundamentals diverge. That skill transfers to every market, every sector, and every cycle. Once you understand it, you stop chasing headlines. You stop reacting emotionally. You stop trying to time tops and bottoms. You start building positions rationally. That is how wealth is built quietly, while others are distracted. In the next section, we will move toward the conclusion of this series. We will tie all 5 stocks together, discuss realistic expectations, portfolio construction, and why avoiding big mistakes matters more than finding the next big thing. We will also talk about what not to do, because avoiding errors is often more important than making brilliant decisions. If this breakdown helped you think differently about investing, please like the video and subscribe to the channel. It helps support the work, and it ensures you do not miss the next part of this series.